Hello and welcome to this week's podcast, brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. I'm Michael Hewson, on camera this week, which may or may not be a good thing for your viewers out there. And joining me again is Pepperstone Senior Market Strategist Michael Brown, fresh from the latest inflation numbers out of the US. And I think they're particularly topical, I think, given what we saw from the Fed last night. And two I'm not going to say this, two job applications for Powell's position from two dissenters.
Yeah, absolutely. That's exactly what they were. Very good afternoon to you, mate. Good afternoon to, or hello to all our listeners. Yeah, a bit of a hotter than expected inflation, or PCE numbers, I should say, stress out of the States this afternoon, which really just sort of helps to vindicate the wait and see approach that Fed Chair Powell and the majority of his colleagues on the FOMC continue to believe is appropriate. Of course, we don't know exactly the degree to which tariff-induced price pressures are going to impact the economy. We don't know how long those price pressures are going to last, and a patient wait and see approach remains appropriate in the Fed's view, and certainly in my view as well, unless, of course, you are one of the ambitious governors who was put into the post by President Trump a few years ago and now wants the top job next May, in which case you're dissenting in favour of an immediate 25 basis point cut to try and get on the Donald's good side.
Yeah, indeed. And certainly I think Powell is not on his good side given his comments this morning. But, I mean, there's no surprise in any of that. And we'll dig into that a little bit more in a minute after the risk warning.
Yes, and given that we're going to get into the sort of controversial subject of Fed independence, I think a risk warning is probably advisable.
Absolutely. So the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 73.7% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so topics for this week, and it's a busy week. I mean, we know it's busy. We talked about it a little bit last week, but obviously, what's driving markets this week? Again, we've got the tariff deadline, which is due to expire on the 1st of August, but at least we are starting to see the details of some deals. So we'll talk about the EU-US one. We'll talk about US second quarter GDP as well, because I think that beat expectations. We'll expand a little bit more, point two on the Fed discussion, which we briefly touched upon in our brief summary before the risk warning. And then we'll look at the earnings this week, which by and large have been very, very good indeed, both on this side of the Atlantic and the other side of the Atlantic. So we're going to talk about NatWest, HSBC, Barclays, AstraZeneca, Rolls-Royce, Shell, Next, touch upon Unilever, talk about the Magnificent Seven, particularly Microsoft and Meta's gangbusters results from last night, and then we'll move on to next week, and where attention shifts to the Bank of England and some other earnings numbers from the likes of BP and Diageo, and our old customer favourite Travis Perkins, as well as Disney. So without further ado, let's get cracking. So the US-EU trade deal, 15% tariffs for the EU, 0 tariffs for the US. Who's the mug here?
Well, that's a very good question, and I think it depends on the context surrounding the question, frankly. If we'd sat here in January or even this time 12 months ago and someone had walked into the room and gone, Mike, the EU are going to be paying a 15% tariff, charged a 15% tariff on their exports to the United States in 12 months' time, I think we'd have both turned around and gone, well, that's utterly terrible. What are you on about? How on earth could the market be trading at an all-time high on both sides of the Atlantic against that sort of a tariff? The dynamic has clearly changed quite considerably since then. Of course, at the start of July, we had Trump threatening a 50% tariff on the European Union. That threat then went down to a 30% tariff, and they've now agreed a deal at a 15% 15% tariff. So I can completely understand the outcry that we've seen from various member states. France and Germany don't seem particularly big fanatics of this agreement. But to be honest, and I'm going to have to go and wash my mouth out with some soap after saying this, I think maybe we do need to give a little bit of credit to Ursula von der Leyen, because it's probably the best deal she was going to get. The alternative was tariffs at least double that level and likely a recession in the Eurozone, whereas a 15% levy, it's high, yes. It's probably most of that will be paid by the US consumer anyway, and they're going to negotiate carve-outs for certain important sectors anyway. We're already seeing them talk about wines and spirits, for example. So it's not the best deal in the world. It was never going to be the best deal in the world. I think the key for markets and for the economy in the short term is that it is a deal, which means we can rule out a no-deal scenario and hopefully move on to matters that are much more interesting and important.
But it's not just about tariffs, is it? It's also about massive investment by the EU with respect to US energy.
Yes, that is true. Although I would say that it might be an understatement to say I'm skeptical that any of that investment will actually come off. I mean, I think the reference point I would use is the phase one, as it was back in the day, US-China trade deal from 2018-2019. If you recall the huge agricultural purchase commitments that China made during that deal in terms of soybeans and things like that, none of them were ever purchased. China never held up their end of the bargain. And I think that's probably going to be quite similar with the majority of these trade deals. I reckon if you added up all of the purchase commitments that have been made, not just by the EU, but by Japan, South Korea, Indonesia, I mean, the US probably doesn't produce anywhere near enough energy for all of this to actually be bought, let alone the other side actually wanting to uphold their end of the deal. And then, of course, when it comes to the issue of investments, you know, there was talk of $600 billion worth of investment from Europe into the United States. Well, all of that's going to come from private companies, and Brussels have already admitted that we have no control over what private companies do. If they don't want to stump up that amount of cash, then we're not going to meet that part of the deal. So I suppose that raises the risks that at some point in the future, Trump may turn around and say, you're not upholding your side of things, and, you know, we're going to send you another letter or whatever it may be. But yeah, I'd be tempted not to read too much into those purchase commitments at the moment, to be honest.
That perhaps helps explain why the DAX hasn't made new record highs. It made a record high on July the 9th, and since then it's been trading sideways. I don't think European investors know really what to make of this deal. Yeah, it's not, you know, it's not a terrible deal relative to what could have been. But the downside is very difficult to measure in terms of what the downside actually is and the effect that it's going to have.
It is, and we've also seen a fairly big reversal in the euro as well, you know, trading down around sort of 114 now, whereas we were up about 117, 118 in terms of spot euro dollar this time last week. So we have seen quite a big reversal in fortunes in Eurozone assets in general. And yeah, I do think there's probably a little bit of indecision within the market. The other thing that may be pressuring the DAX slightly is that one of the purchase commitments that was in this deal was around buying US military equipment. So if people were thinking that those orders would go to companies like Rheinmetall, then maybe you'd be pricing that out a little bit. But the other thing to remember is, you know, we are, although the weather down on the south coast where you are wouldn't imply it, we are in the summer at this point. So investor participation in the markets is probably much less than it would be in sort of normal times anyway.
Yeah, and Michael's reference to the weather down here stems from the fact there's a thunderstorm actually unfolding outside my window. So.
Yes, and I had the pleasure of seeing Mr. H running around in his tracksuit bottoms, hurrying to close windows before we hit record.
Close the Velux windows, yeah, thanks for that, mate. Anyway, moving swiftly on. I mean, I think
wisely.
I think one of the reasons we've seen a weaker euro is the dollar's been stronger. And why has the dollar been stronger? Well, we talked about it when those Q1 GDP numbers out of the US came out, when you had that massive influx of imports, which caused the economy to contract. That's been reversed in Q2, and now we've seen a massive outperformance in second quarter GDP, 3% on an annualized basis. So we saw a 30.3% drop in imports, which helped reverse a 37.9% surge in Q1. So we said that would happen. It's happened. The economy is actually stronger, I think, than was expected. And obviously we've got this morning's or this afternoon's inflation numbers, which is also starting to get the markets price out to some extent the possibility we may see a rate cut in September from the Fed.
Yeah,
I think we will. I think we will, but we're getting some repricing taking place here.
Yeah, we absolutely are, and I think we'll get onto the Fed in a bit more detail momentarily, judging from the notes here. I think what I would say in terms of GDP is actually I quite like the way that Chair Powell was phrasing things yesterday in terms of let's just look at H1. Let's ignore Q1 and Q2 and let's not take them separately because, as you rightly said, in Q1, the US was dragged lower by this surge in imports. In Q2, it was inflated by this surge in imports. Over the first half of the year, the US economy grew by just over 1%, which is okay. It's not great. It's slower than it was last year.
Yeah, exactly.
But it's still growth, ultimately. I would actually point to a slightly different reason for the rebound in the dollar. And the way I've sort of been looking at things over the last week or so and talking to clients about it is the markets just ran out of reasons to sell the greenback. If you think about why there were so many dollar bears in the market, one of those reasons was risks around trade. Well, we've had a number of trade deals agreed over the last week or so. You can debate the merits of those deals, but there is a deal there, and we have some certainty on the tariffs that are going to be paid. President Trump, apart from a sort of ranty social media post this morning, appears to have slightly backed off on his attacks in terms of Fed independence. He's at least saying he's not going to fire Jerome Powell, which is one thing that the market had been quite concerned about. And as you said, we've had this sort of marginal hawkish repricing of policy expectations as well. So I think it's a case of the market was probably caught overly short the greenback, and we're now seeing that snap back a little bit, although we have come a very short way in a very short space of time. I think over the last sort of 7 trading sessions, the dollar index is up almost 3% and north of the 100 handle this afternoon. So again, now I'm sort of sat here going, well, actually, maybe we've now rebounded too far in too short a space of time, and we actually end up, sort of fading the rally, perhaps.
Yeah, if you look at dollar yen, which is now back above 150, it's also back above the 200-day moving average.
It is.
And it's broken above the highs that we saw in April, May and July. So perhaps there's potential for more dollar gains going forward. Perhaps this isn't the end of the dollar rebound.
No, I certainly wouldn't rule that out. Then the dollar index is north of its 100-day moving average. Incidentally, the yen is slightly idiosyncratic, and without getting into the weeds of the Bank of Japan, they yet again seem to be finding any excuse not to hike rates, or even say they're thinking about hiking rates, which is why the yen is continuing to face some fairly significant headwinds. But I certainly wouldn't be sat here sort of calling a top in the dollar just yet. That's for sure.
So the potential is we could see a move towards 130 in cable and potentially a move towards 112 in euro dollar.
Yeah, potentially. I certainly wouldn't rule that out. And that 130 mark in cable has been a key psychological barrier for God knows how long now, probably since the referendum almost.
Well, as long as it stays above 130 for the next couple of weeks, I'm not really that bothered.
Just because of your holiday.
Well, I don't know what you're talking about.
Well, when you're over in the States, you're going to have a word with Trump and tell him to back off on the Fed and that they're actually doing a damn good job.
Yeah, I might do that. But the thing is, I'm a bit worried about getting through customs if I'm too outspoken. Or through immigration, I should say. Yeah.
I think that's a very fair concern, mate.
Okay, so let's talk about the Fed. Obviously, I think there was an awful lot of what I would call positioning going on in those two dissents. To my mind, I think those two have lost credibility in light of the numbers that we've seen today and the weekly jobless claims. The US economy looks in fairly decent shape. It doesn't need lower rates at this point. So for me, I think Powell is doing a good job. Trump may disagree, but Trump is a real estate magnate. He's not a central banker. And I think we're also seeing an awful lot of support, I think, from other people that actually think that Powell is doing the right thing.
Yeah, absolutely. I fully agree with you. There is absolutely nothing when you sort of look around the economic data that's coming in, whether it be in terms of the labour market, as you said, the jobless claims numbers. Of course, we have the July labour market report tomorrow, so do bear that in mind if you're listening to this podcast over the weekend. Whether you look at the inflation side of things, CPI moving higher, core goods prices in particular moving higher, PCE moving higher, core PCE moving higher. So inflation is moving away from the Fed's target at the same time as the labour market is still strong, at the same time as consumer spending remains resilient and business activity is still pretty solid as well. So against that sort of backdrop, you go, there's nothing crying out for a rate cut. And actually, the data that we're seeing serves to reinforce and to vindicate the patient, prudent approach that the Fed are taking, which is to simply sit on the sidelines and go, all the time the economy is resilient. We have the time, we have the space to just wait and watch and see what happens. And when we're confident that we're sort of over the hump of these tariff-induced price pressures, that is when we will then start to deliver one or many rate cuts and bring the Fed funds rate back to a more neutral setting. And as you said in the introduction to the show, I think that the absolute best lens through which to view those dissents from Governors Bowman and Waller is simply as a job application for Fed chair next May, basically going, pick me, Mr. Trump, I'll vote for rates to be lower. And frankly, it's utterly shameless that they would use their position of influence to try and further their own personal objectives and not focus on the policy outcome that's best for the US economy.
Yeah, absolutely. 100% agree with you on that, mate. Anyway, let's move on. Been a good week for the FTSE 100 yet again.
Indeed, yeah. What are we on for now? A sixth straight week of gains?
I think so, yeah. I mean, we're at 91.53, and who could have predicted that? I think, a few months ago. But yeah, absolutely.
Well, you want me to say you at this point, don't you?
I'm saying nothing. I've done my victory dance. I don't need to reinforce it. I mean, the breakthrough 8,900 has been the catalyst for a really strong move higher, and momentum appears to be very much in the FTSE 100's favour. We had a decent set of numbers from NatWest last week. Now fully back in private hands. Solid set of Q2 numbers. Profits attributable to shareholders at 1.24 billion. Slightly lower from Q1, but more or less, 2.5 billion over the half year. No, I didn't see anything significant in terms of weakness in those numbers, aside from the fact that impairments were slightly higher at 389 million pounds. I mean, that was really as a result of additional costs due to the acquisition of Sainsbury's Bank.
Yeah, no, you're absolutely right, and a decent buyback program in there as well. I mean, Frank, sorry, I was scrambling to find the right page in my notes there, but yeah, absolutely. I think there's not really anything to dislike in those earnings from NatWest, and as you rightly said, now fully returned to public ownership. Easy for me to say. So you would hope that they can now sort of go from strength to strength.
Looking at the share price, we've seen a little bit of a pop higher. We haven't quite got through the highs that we saw in June, just below 540p, but the line of least resistance does appear to be for further gains, but that is going to be a barrier. Those June peaks are the next obstacle to a move higher. And as you said, a £750 million share buyback and an interim dividend of 9.5p. So, basically shareholder friendly once more.
Which is actually, we're going to come on and discuss them momentarily, but that's very much in keeping with the sort of general theme of bank earnings here in the UK this week. I think all of the banks that have reported, Barclays, HSBC, of course, Standard Chartered reporting this morning, they've all increased their buybacks. So, very sort of shareholder-friendly decisions coming from those firms.
Yeah, I mean, what did you make of the Barclays numbers? Obviously, Barclays has a big investment bank, and I would have been surprised if those numbers hadn't been good, given the decent numbers we've seen out of US banks. But again, here, share price it's at its highest levels, I think, pretty much since the financial crisis.
Yeah, I think you're right on that one. And again, I don't think the earnings were particularly surprising. They were certainly a strong set of results, and the profit line beating expectations. But as you said, we'd already had that lead from the major banks on Wall Street, where Q2 trading revenues have been very, very solid indeed. And of all the banks present here in the UK or listed here in London, Barclays are probably the one with the largest investment bank, the largest trading arm. So that pickup in market volatility and also that pickup in deal making activity have clearly helped things. And they've announced a £1 billion worth of share buyback as well. So, again, not really much to dislike among all that.
Yeah, investment bank division saw net trading income rise 28% in Q2, 25% in the first half. Advisory disappointed. But, I think advisory has been a weak spot for all of the banks this
Yeah.
first half of the year. So, again, no surprises there. HSBC, though, a little bit disappointing. The market didn't really like those numbers.
No, you're right. HSBC have seen a little bit of downside on that one, and that's primarily, I think, because costs have increased. And particularly when the competition have set a relatively high bar, the market's naturally going to take a relatively dim view of any softness that's coming through. And I think that's exactly what we're seeing in terms of those results: costs higher and losses in the China arm as well.
Yeah, weakness in China, and obviously there is still no deal between the US and China. So I think
Of course.
perhaps there's an element of caution there.
And I wonder whether that is going to raise the perennial question of splitting HSBC in two, which no one seems to have spoken about for about 6 months or so. So that's long overdue to come back in the agenda, surely.
I think that's part of the restructuring process that the new, I say the new CEO, he's been there a while.
He's been there about a year now, hasn't he?
Yeah, but that's part of, I think, the restructuring process that's currently taking place, so that if they are forced to spin off the UK operation, which is also performing reasonably well, it'll be a lot easier to do. But certainly I think the fact that they've seen a significant slowdown in profits, it wasn't just confined to Hong Kong, it was also confined to the UK, because profits in the UK were lower by 250 million in H1. So perhaps there's a little bit of a pullback in profit taking. I mean, and if you look at HSBC over the last 2 years, it's one of the best performers. So there's certainly more potential for it to pull back than, say, the likes of Lloyd's, NatWest, and obviously Barclays.
Yeah, absolutely. And of course, as all of those beat expectations and HSBC come in somewhat soft, then that's always going to exacerbate those declines.
Decent numbers from the pharmaceutical sector this week. GSK beat expectations, as did AstraZeneca. Interesting that Pascal Soriot didn't mention anything about relocating to the US. But one thing that he did reiterate in his notes was the $50 billion investment in the US.
Yes, and I think he's probably wise not to mention the potential relisting, given that would really set the hairs running on that front. But not particularly surprising in this sort of an environment that he would mention that investment in the US, because, of course, the big thing that hangs over AstraZeneca, GSK, and, of course, all their rivals is what the Trump administration are going to do in terms of pharma tariffs. So all of the CEOs are going to try and ultimately be as America first as Trump at the time being, to get as low a tariff rate as they possibly can. I think that's really the big focus for the sector at this moment in time. So no surprise that he's touting that big investment in manufacturing stateside, probably hoping that it will curry a few favours with the administration. Yeah,
$50 billion in the US, including a manufacturing site in Virginia. So I think that's the carrot for Trump to go easy on them, perhaps.
Yeah, absolutely. But whether Trump does or not remains to be seen.
Oh, 50 billion isn't an inconsequentially low number. I mean, when you consider the fact that the UK missed out because they weren't prepared to stump up an extra 40 million quid.
Oh, no, I agree. I agree. And I think that says more about our government than anything else. But we really don't want to go down that route.
No. We've been down that rabbit hole, I think, most of our listeners.
And we will many more times in the future, I'm sure.
Yeah, I think most of our listeners know our views on this current
this
current government. So let's not go over rehash older prejudices, shall we say.
No, definitely not.
Okay, BAE Systems, decent set of numbers, not surprising really, but the shares, they slipped back, which surprised me somewhat. They upgraded the full year guidance on both sales and profits, with growth in all areas of the business. It's a bit of a strange one, that. Order backlog was lower by 2 billion, but I mean, they've got an order book of 75 billion pound. I don't think the 2 billion reduction in the order book is neither here nor there.
No, it's relatively minor in the grand scheme of things, to be completely honest with you, isn't it? And I think this might well be a classic case of the market having got a little bit ahead of itself in terms of this whole defence spending boom that we're going to see. And as a result, just a little bit of a pause for breath in terms of the share price. As you say, the order book still looks healthy. Sales are moving in the right direction. Underlying earnings have moved higher. So really, is there that much to worry about? I don't think so.
Looking at the chart, there is potential, I think, for a little bit more weakness, perhaps. But the shares do appear to have stalled since peaking in late May, early June, and they've started to slip below sort of the 1800 area. I think the 1800 area is currently supporting the share price, but if we drift below that, we could see it drift back towards 1600. Momentum is starting to slow a little bit, but the investment case hasn't changed. It's still a fairly decent business with very, very solid growth prospects. So, you know as well as I do, shares can go down as well as up. It's never a straight line, and it's always very much a case of investing for the long term.
Yeah, absolutely. And as you rightly say, the investment case hasn't really changed, to be completely honest. So if you are, and we're not offering any sort of investment advice on this podcast, that's for sure, but if you are still a believer in that investment case, then that dip is likely to be seen as a buying opportunity.
It's about offering perspective, I think, more than anything else, because as with anything, when you're looking to buy shares, you're looking not for the next 1 month, 2 months, or 3 months. First and foremost, you're looking for the potential for growth, but also you're looking for the potential for return, whether that be dividends, share buybacks, or what have you. But ultimately, it's about developing a mentality that means that, while not being risk averse, because you look at, say, for example, the percentage of UK investors who own stocks compared to the US. UK investors, the percentage of the UK population who owns stocks is around about 24%.
I'm surprised it's that high, to be honest.
I'm surprised it's that high. In the US, it's 68%.
Yeah.
So that's the sort of mindset that you have to overcome when making a case for stocks and shares. And yes, they are risky. The value of your investment will go down as well as up. But if you hold that investment over 5 or 10 years and are nimble and you spread it across, a wide asset class and wide number of sectors, then generally you should come out ahead.
Yeah, absolutely. And this could well be a whole separate podcast in itself, to be completely honest with you. But I think it's also around...
Maybe we should do one.
I think we probably should at some point. There we go. That's something we can do maybe over the summer when things quieten down a little bit. But yeah, the thing to do is it's around perception of risk. Because, as you rightly say, the value of a stock investment or a share investment or an index fund investment can and likely will go up and down, and it will fluctuate over a period of time. The longer that period of time, the more the odds are in your favor that the balance of probabilities will see that investment rise in value over the course of which you hold it. The way risk is viewed, though, I think is slightly skewed, because it shouldn't be viewed as a case of, does my investment go up or down? I think it should be viewed as, what is the real return on an equity investment compared to the real return on a cash investment? Because if you consider, for example, here in the UK at the moment, the most savings accounts, instant access will offer 3.5%, 4% if you're lucky.
2.5%.
There you go. So let's call it 2.6 because it makes the next bit a bit easier. Inflation's running at 3.6. So your real return on that is minus 1%. That's the way that risk should be viewed around the opportunity cost of not being invested within financial markets. And again, not financial advice in any sense, but it's a case of, in the United States, there is that attitude of, if you want to build wealth and if you want to generate a real return in excess of, a relatively paltry cash return, you need to be in the equity market. Whereas here in the UK, it's viewed as that conversation doesn't happen. It's a case of, I could buy stocks and they go down tomorrow, so why would I want to do that?
I started saving for a pension when I was 19 years old, and we were only talking about 20 quid a month, which was nothing. But that 20 quid a month compounded over 30 or 40 years is worth a lot more now than if I just left it in a simple savings account.
Yeah, absolutely. Well, there's
And that's the point. And I think there's too much short-termism when it comes to looking for a return. When in fact, if you're saving for a pension, £20 a month is neither here nor there. But over 20 or 30 years, if you can afford to do that,
yeah,
it doesn't have to be 20; it can be 10.
yeah, whatever.
But
But
if you compound that over a period of time, it should easily outperform cash.
yeah, absolutely. Well, there's that saying that compound interest is the best modern wonder of the world, or whatever it is. I probably completely butchered that, but it is true. If you lock your funds away and let it compound, then a small amount can grow into a nice little nest egg. But I think that's a separate podcast, and we must do that because it's a very, very important subject.
Okay, so let's move on. Rolls-Royce, new record highs today. They've not only posted new record highs, they've upgraded their guidance on underlying operating profit and free cash flow. And the main driver of that outperformance has been in its civil aerospace division. 7% improvement in operating margin, 7% to 24.9%. But they've also, large engine order book, seen a big jump in orders.
Which is good to see, because we know that Rolls-Royce have been struggling on that front recently. So it's good to see that confidence among their clients is coming back. It's good to see that order book is being rebuilt. And again, Rolls-Royce is one of those real, sadly rare, but very promising and positive homegrown success stories here in the UK. And as you said, the stock trading at record highs as we record this podcast. And frankly, you look at the stock, the civil aerospace division seems to be doing very, very well. Obviously, the nuclear power side of things is starting to kick into a higher gear, and also the orders will be coming from the defence sector as well. So again, you'd like to think that Rolls-Royce's prospects look very, very good going forwards over the medium term.
Yeah, they said that they expect the SMR business to be profitable by 2030 and to start generating revenues by the end of this year. And, when I look at Rolls-Royce and I look at where the share price was 3 years ago, it was at 70p.
Yeah.
Now it's at £10.
Yeah. It's a huge move, isn't it? Absolutely huge move.
You buy 100 shares, 70p 3 years ago. That's all we're talking about, 100 shares. So now
we're not saying that every stock in the world is going to do that before anyone clips this up and starts using that, but it just shows the power of the equity market and the power also of very strong and driven corporate leadership to turn around a company's fortunes, as they have done at Rolls-Royce.
I mean, so many people were writing Rolls-Royce off 3 or 4 years ago completely. I had this discussion, I had this argument on social media a few years ago, but this guy in the States was basically saying I was a mug for thinking that Rolls-Royce were going to survive. Yeah, and you're thinking when the share price has fallen from say £7 or £8 to 50 or 60p, and it's a key defence contractor, do you really think the government is going to let it go bust? So,
of course it's not.
So throw a bit of money at it and sit on it for 3 years and see what happens.
Yeah,
and
absolutely.
This is exactly what happened. It was the same thing with RBS back in the day when it went down to 10p. I bought 100 quid's worth of shares at 10p, and I sold them about 2 years later for £1.
Yeah, there you go.
It's a no-brainer. If you can afford to lose that £100,
don't.
I'm not saying don't throw money at something, but
don't just throw money at every stock in the world. Please don't go doing that.
It's about weighing up the risks.
It's
what's
that risk-reward calculation.
It's what's your downside. You throw £100 at a penny stock, which is essentially what RBS and Rolls-Royce were at the time, or £1,000 or 500, whatever you can afford. Just take a view on it.
Yeah.
What's your ultimate downside? Now, obviously, with leverage, you can't. With leverage, your downside is more than the initial investment. Don't do that. Don't do that on leverage. Buy the physical shares.
Yeah, absolutely.
And then your downside is limited to the money that you've put in.
Yeah, it's your initial deposit.
Yeah, and that's it. And then just sit and wait.
Yeah, and watch markets do their magic. Hopefully,
exactly. Anyway, so Rolls-Royce again, record highs. I can't help feeling that it's starting to get a little bit expensive, but at the end of the day, it's got momentum on its side.
Yeah.
we've gone from £10, we've touched £11, and we've dropped back a little bit, and we're in the middle of that right now. So, is it too late to get in? For me, I would probably wait for a dip.
Yeah.
If you're not already a shareholder in Rolls-Royce, wait a bit, I think.
Yeah, I think that's probably wise.
You're paying the absolute top. Similarly, Shell this morning, slightly better than expected. Still weren't great numbers though, but the market seemed to like them. We're up 1%. But again, I think that just highlights the problems facing the oil and gas sector. It'll be interesting, I think, in the context of BP's numbers next week. We've got another 3.5 billion share buyback. Annual capex kept unchanged, but all of Shell's divisions saw declines in adjusted earnings. Integrated gas, chemicals, profits were down. But again, I think it was a case of they lowered the bar a month ago.
Yeah.
And they beat the bar.
I think it's a sort of lesson in good investor relations where you've already massaged expectations lower such that when you release the results, they don't come as a surprise to markets. It was a bit of a weird report, to be completely honest with you, because earnings were down by a third, but they've raised their dividend and they've maintained the buyback, and profits beat expectations but were considerably lower than they were quarter on quarter and this time last year. So I think they were quite clever, as you say, to come out a month ago and talk down their own prospects, which no company ever wants to do, but it has probably, well, as clearly as we can see from the reaction today, it has really limited the potential damage that the stock could have suffered if you just released that out of the blue.
Well, there's been no damage to it whatsoever because the shares are exactly where they were a month ago.
Yeah, precisely. So I think they were clever to do that.
Yeah, expectations management.
Yeah, it's that that classic thing of massaging expectations and then coming in above that bar.
Indeed,
that you've artificially lowered yourself, basically.
Well, exactly. Let's talk next.
Go on.
Another profits upgrade.
Well, we spoke last week, didn't we? And said, is this going to be as we do every quarter, is this going to be the quarter or is this going to be the half where Next don't deliver that upgrade to their guidance that they seem to always deliver? And clearly the answer to that question is a resounding no, because they did indeed upgrade their guidance, and they continue on that streak of constantly upgrading their own expectations.
Yeah, but the share price is down, which is surprising. Until you dig a little bit deeper into the numbers, which I decided to do. They full price sales in Q2 were up 10.5%.
There's someone who hasn't been worried about tariffs all day.
Yeah, exactly that. Online appears to have driven most of the improvement with an increase of 9.5%. Retail stores added 5.6%. I think they could have actually benefited from the problems at Marks and Spencer's. And obviously the problems they had with their online service because of the hacking.
Of course.
Have you. So I think there's an element in that. But what I did see was that international online appears to be driving this improvement in Next overall profitability. They've raised their profit guidance. But what was interesting on their UK numbers, Next was more cautious, saying that UK guidance for sales for H2 is only 1.9% versus 7.6% in the first half, which is a big drop, and that consumer spending is expected to slow materially in H2. On the other hand, guidance for international was increased from 13.1% to 19.4%.
Which is a big increase.
Which is a big increase. I mean, obviously, it's a smaller part of their business, but what it does tell us is that most of this improvement that we've seen in Next's overall numbers in the bigger picture has not really been driven by the UK, which has performed well because of the warmer weather, but it's going to be international that supports it in the second half of the year.
Yeah, and I think actually that's a really interesting point, because we spoke not only last week in the context of Next earnings, but also more broadly around the UK consumer, where we've seen, or we saw, I should say more accurately, spending pulled forward into the year because basically it was hot and it was sunny much earlier in the year than you would ordinarily expect. So people going out and buying, sun hats and shorts and T-shirts and God knows whatever else. And, that has then resulted in potentially a weaker second half of the year than you may otherwise have expected. And of course, you've also got other consumer headwinds, such as the rapid weakening that we're seeing in the UK labour market, which may also pose a downside risk there as well. But I think it's interesting that they cut their guidance so significantly, because I think that speaks volumes about where the UK economy may be headed in the next 5 months, the final 5 months of 2025.
Yeah, and that's the key issue. They've cut their UK guidance, but they've raised their overall guidance.
Yeah,
which tells me the company's doing well. They've raised their profit before tax guidance by 25 million to 1.1 billion pounds. But the part of the business to keep an eye on is UK.
Yeah, absolutely.
And they are not confident about that at all.
Yeah.
Okay, so that pretty much brings us to the end of the UK, summing up for this week. Let's talk cloud. Let's talk Meta and Microsoft. I mean, wow.
Yeah, that sums it up, really, doesn't it? I mean, the Magnificent Seven are still magnificent, or at least those two of them are, to say the very least. Blowout earnings from both Microsoft and Meta after the market closed last night on Wednesday. The Nasdaq 100 trading to a record high as a result. Microsoft's market cap now north of $4 trillion, only the second company after Nvidia to reach that milestone. And frankly, I think there's two takeaways from this. The first would be, before we get into the numbers, broad takeaways, the first would be the sort of arms race in terms of artificial intelligence shows absolutely no sign whatsoever of slowing down. CapEx is going through the roof, as we saw it also with Alphabet last week, and that should continue to support the picks and shovel stocks, if you like, of Nvidia and Broadcom and Qualcomm and such like. And the second thing is we're actually starting, importantly, we're starting now to see signs that this big bet that companies like Meta made on AI being this huge revenue boost to the firms, we're actually starting to see signs that that is paying off now as well, which I think is also a really significant sign for investors, because one of the worries have been, fine, you're spending all of this money, are you actually going to produce a return on it? Well, these companies can now turn around and say, actually, we're already starting to produce a return on it, and this is just the start.
Yeah, and we said last week that Microsoft's revenues for the quarter, $75 billion. So essentially, they're looking to spend on an annual basis the amount of quarterly revenue on AI. Now they're looking to actually scale that up, because when I looked at the numbers yesterday, Microsoft said it was going to be spending $30 billion in the current quarter.
Yeah.
As it looks to build out its ability to power AI services. Will you extrapolate that over the year? That's $120 billion a year.
Yeah. And we mentioned this last week, but we sort of throw these numbers around. It's really hard, and even I'm sat here struggling and doing this all day, to contextualize how big these numbers are. A firm that is almost printing money at this point and is going to spend $120 billion on CapEx over the next 12 months. It is insane. I don't think there's any other word for it.
On cloud and AI.
Yeah.
And yet last year, Azure revenue came in at $75 billion for Microsoft. That's for the full year.
Yeah. With forecasts for that to continue increasing, of course.
Yeah. An increase of 34% annually, with an expectation that we'll probably see another 35% in 2026.
And even that is, even that growth rate is wild. The company growing at 30% a year.
37%. My mistake.
Yeah.
37%.
Well, even better. Yeah. I mean, what's an extra 7% between friends?
Yeah, exactly. And it's the same with Microsoft. I mean, they've revised up their lower boundary on CapEx for 2025 from $64 billion to 66.
Meta,
Meta. Yeah. So 66 to $72 billion on CapEx.
Yeah.
For 2020. For this current year. And you look at the overall business revenue for the quarter, $47.5 billion, an increase of 22%. Now, I said at the time their forecast was for $45.5 billion for Q2. They've beaten it by $2 billion.
It's ridiculous. And we almost say that as if it's expected. But, if you go back 3 or 4 years, a $2 billion beat on revenue expectations is huge. And it's no surprise that the stock is trading up, 10% or so on the day. But I do think this is interesting because, in true Blue Peter fashion, here is a chart I prepared earlier, which I appreciate none of our viewers are actually going to be able to read. But there is this interesting divergence opening up now in the Magnificent Seven, where you've got Nvidia, Microsoft, and Meta, who are all up, as near as makes no difference, 30-odd% on the year. And then you've got Amazon and Alphabet, who are trading marginally positive, but underperforming the benchmark indices. And then Apple and Tesla are down 15 and 20% apiece. So the Magnificent Seven that was, these are the tech stocks that are just going to continue rallying through the roof. Well, actually, they're sort of being split into 3 chunks, it seems, at this moment in time.
Indeed. Yeah. I mean, it'd be interesting in that context to obviously look at Apple's results later this evening.
Sadly, I don't have those in front of me. I'm not allowed advanced sight of them.
No, I mean, the thing is, I think what are we going to look out for Apple? I think for me, the most important thing is obviously these India tariffs.
Yep.
Whether or not, Trump decides to throw the book at India. But also its AI offering, Siri. What's Apple doing at the moment? What's its USP?
Well, I think, frankly, they don't have one. I would argue the only sort of USP that Apple has at the moment is effectively ubiquity, where everyone has an iPhone, everyone has an Apple Watch or an iMac or whatever.
I don't.
I knew you were going to say that just to prove me wrong.
I've got an iPad, though.
The vast majority of people, apart from you, have an iPhone or an Apple Watch or an iPad or whatever it may be. So they've got that sort of incumbency. Yeah. They haven't taken advantage of that at all. The launch of sort of integrating AI into Siri has flopped terribly. I think we would all agree with that. And I think as time goes on and as the progress Apple make on the AI front remains sluggish at best, speculation that they're going to end up buying a more established player in the market is only going to increase. You look at all of the private AI firms that are out there, whether it be Anthropic, whether it be Perplexity, whether it be OpenAI, Apple has sat on a pretty big cash pile, and if they think that's the only way they're going to catch up, then I don't think they're going to be afraid to pull the trigger on that sort of a deal if they need to do it.
Yeah, I think Perplexity, though, isn't that I've got that as part of my LinkedIn. So maybe there's a Microsoft tie-in with Perplexity there.
And there's also one with OpenAI, of course.
Yeah, indeed.
So,
and Amazon, the key thing to watch out for is obviously Amazon Web Services, which obviously is a much bigger proportion of their overall income relative to Microsoft and Alphabet. So things to look out for in the earnings tonight for Amazon is going to be, obviously it's retail, it's huge relative to Walmart in the US, but also Amazon Web Services and the growth there.
Yeah, most definitely. Should we do the week ahead?
Let's do the week ahead. Okay, the big thing that's caught my eye is the Bank of England.
Let's not do the week ahead then.
25 basis points, yay or nay?
Well, they're definitely going to cut 25 basis points, I can tell you that. And they're also going to say once again that they will continue to take a gradual and careful approach to further steps in terms of policy easing. What we don't know is what the vote split is going to be, because again, we have an MPC that are very, very bitterly divided. I would imagine that we see external member Dingra dissent in favour of a larger 50 basis point cut. I would also imagine that we probably see external member Catherine Mann dissent in favour of holding rates steady. She's spoken about how inflation is still considerably north of 2% and how that is a challenge for the MPC. So you're probably looking at a vote that's 177 in terms of unchanged 25 basis point cut, 50 basis point cut. I think this meeting is probably more of a headache for the BOE than they would have envisaged a few weeks ago, because a few weeks ago it was very much looking as if inflation's on a relatively nice downward path, underlying inflation is easing, the labour market is weakening, we get to August, we'll have another round of data confirming that, we can pivot in a bit more of a dovish direction and provide a bit more support to the economy through the autumn. Well, That's clearly not going to happen anymore because inflation moved higher in the month of June, as we've already discussed on the podcast. They're likely to increase their inflation expectations as a result of that. So I think it's very much going to be a case of, as you were from the BOE, they'll deliver a cut because they've guided markets to it. They don't want to deliver a surprise on that front and inadvertently tighten conditions, but they're certainly not going to signal that they'll be easing at a more rapid pace going forwards.
And why would they? I mean, since the October budget, we've seen 3 rate cuts from the Bank of England, and
which are all thanks to our esteemed Chancellor Rachel Reeves, of course.
And the net result of that is the 30-year gilt is actually higher in yield terms than it was then, and it's actually at 30-year highs. So rate cuts don't necessarily equate to lower rates.
No, and this is a lesson that the United States may end up learning relatively soon if Trump gets his way in terms of interest rates. But you're absolutely right. I think it's going to be a bit of a balancing act for Governor Bailey at the press conference, because he's going to stick very much with this wait and see, gradual and careful, we'll lower rates but won't hurry to do it approach. But of course, the media will rightly be probing him on, one, should you be cutting rates at all when inflation is actually moving away from your target as opposed to closer to it? And you're probably going to forecast that inflation will move even further away from your target over the short term. And secondly, on the flip side of that, should you be easing policy more because the labour market is weakening at such a rate of knots that the slack that's developing means any hump in inflation is going to be short-lived? So I wouldn't want to be in Mr. Bailey's position next Thursday lunchtime trying to face down that potential storm.
And the economy is slowing.
Indeed. And we get Q2 GDP in the middle of August, and it's probably going to point to a quarterly contraction, you would expect, given the leading indicators we've seen.
Yeah, I mean, Bank of England seems to think that we'll see a 0.1, 0.2 expansion. We saw a 0.7% expansion in Q1, but an awful lot of that was driven, I think, by tariff front loading.
Yeah, and if you think about the data we've had since then, we had GDP, and the month-on-month data is very noisy, of course, but the economy contracted in April, it contracted again in May, retail sales hardly rebounded in June, and the PMIs are still pointing to a pretty weak output backdrop, certainly in the manufacturing sector. So I think that forecast's fanciful, to be polite.
So we've got services PMIs and manufacturing PMIs next week, which give us an insight into how Q3 is getting off.
Yes, although they are final releases, so I don't think they're going to be significantly revised from the estimates we've already had.
Okay, so let's move on to the earnings numbers. We got BP, not a particularly slick set of numbers in Q1.
Oh, for God's sake! You tried to sneak that in while I wasn't paying full attention, didn't you?
Yeah, of course I was, mate. The outlook for Q2, not better.
No place for crude puns on this podcast. Come on.
Indeed, mate. Maintenance program was likely to mean lower production. We certainly saw that in Shell's numbers earlier this week. It's looking to boost asset sales to $4 billion this year. I'm struggling to see how they're going to hit that target.
Yeah, certainly with 5 months to go.
Well, yeah, exactly. And given the fact that I think I read somewhere that they sold off their wind farm assets in the US and Indiana for an undisclosed sum. Well, if it's undisclosed, it can't be that much.
No, exactly.
Otherwise, they'd be shouting about it.
Yeah, and it certainly doesn't seem like it's enough to get anywhere near that 4 billion figure. Otherwise, as you say, they'll be shouting about it from the rooftops.
So if they want to basically improve their cash flow by $4 billion, then they need to improve not only their margins, their cash flow, but also their revenue. And the likelihood is, given what we've seen from Shell, is all of them are likely to remain under pressure. So I think asset disposals and conversations about takeovers aren't likely to go away.
No, and of course the other thing that BP continued to deal with is activist investor Elliott, who remain rather dissatisfied, to say the very least, about the progress that's been made on turning around the firm, although they do have, is it new chairman or a new chief executive that they've brought in, or both?
No, they're looking to appoint a new chairman. Helge Lund left.
That's right.
And they haven't replaced him. CEO Murray Auchincloss is still in place, but I think he needs to go.
His days are numbered, so to speak.
He's too tied to the previous regime, It's basically like a leopard's trying to change its spots. And ultimately, I don't think he really believes in what he's doing, because he was so wedded to the Bernard Looney regime that he's being asked to do stuff that he's clearly not comfortable with. So, get someone in who's prepared to take much more of a scalpel to the business.
Which is what's needed.
Yeah, it is absolutely needed. The progress is too slow. The net debt is too high. Ultimately, the buybacks need to stop.
Yeah, you can't be buying back stock when the business is in this sort of a state.
No, you can't. So, and I think if the buybacks do stop, probably not going to be particularly well received. But I think it's something that needs to happen to turn the business around and put that cash to better use.
I would fully agree with you on that one.
Okay. One company that's really flown below the radar recently has been Diageo. It's had an absolute nightmare over the past 3 years, since Deborah Crew took over as CEO, though I think that was an unfortunate consequence of timing more than anything else. I don't think it was anything to do with her per se. I just think she inherited the business at a time when ultimately there was concerns about overstocking, slowdowns in sales pretty much across all of their businesses. And I think she's just been a victim of the fact that she took over the business at precisely the wrong time and botched several profit warnings.
Yeah, no, I would completely agree with you on that. And as you say, it's strange how that does seem to have gone under the radar quite a lot recently. Given the terrible way in which they've been trading and all of the issues that they've been having, doesn't seem to have had anywhere near as much attention as that story should have done.
And the share price has halved since 2022.
But is there value in it here, or is there more downside? That's the question that participants need to weigh up, going back to the risk-reward debate.
Yeah, I think there's more value here than there was 12 months ago. But I mean, I would say that because it's trading at 8-9-year lows.
Yeah, so, I was going to say it's quite a low bar, mate. To be completely honest,
it's a reasonably low bar. The new CEO has certainly got a mountain to climb when it comes to turning the business around. But full-year guidance was kept unchanged. H2 expected to be better than H1. It's based on the assumption that UK and European tariffs would remain at 10%. I think there's been an exemption, hasn't there, on spirits?
I think that's currently under negotiation. Is the latest that I've seen.
And Mexican and Canadian imports would remain exempt under USMCA.
And that is still the case.
And that is still the case.
Yeah.
So, maybe there is a case for maybe there are a nearer base. But having said that, obviously Trump's saying that he's going to levy tariffs on Canada again because of political considerations. We won't go into that because that's a rabbit hole I really don't want to touch. The shares are just above the lowest levels in about 9 years in July, which is around about £18.80, £18.20. So, is it worth getting back in? At the moment, there's no evidence that the downside is over.
No, so I would agree with that.
I would sit on my hands for the time being, find out who the new CEO is, and whether or not they can turn the business around. But they are building a new manufacturing facility in Alabama.
Yes.
So that should insulate it from any further US tariffs.
God, imagine that.
Supply chain.
American brewed Guinness. Ugh. Ugh.
Yeah, I'm guessing it's spirits, not Guinness.
I would hope so. But I apologise deeply and unreservedly if I've just antagonised any of our American listeners. Shall we move on? Because customs aren't going to let me in either at this rate if I want to go.
Got first half numbers from Travis Perkins. Again, we'll talk about that a little bit. It's been one of those companies that really hasn't been able to catch a break. Shares 15-year lows back earlier this year. We've seen a modest rally, but again, that rally again has run out of steam. They've appointed a new CEO, Gavin Slark from SIG, but he doesn't take the reins until the 1st of January 2026.
Yeah, it's a bit of a rudderless ship until then, isn't it? Yeah.
I mean, it's rubbish. I mean, why would you appoint a new CEO, which means essentially the company's rudderless until the end of this year? Toolstation, is doing fairly well. But apart from that, the business is still struggling, particularly the merchanting division. So, yeah, I mean, I think the sooner Mr. Slark gets his feet under the table, the better. But at the moment, the business is adrift.
Yeah, and sadly, it seems like it's going to remain a bit of a drift for the foreseeable future.
Yeah. We've got third quarter numbers from Disney. They've had a fairly decent run of it over the past few months after their Q2 numbers were fairly decent. Revenues increased 7% in Q2, $23.6 billion. Parks and cruises helped in this regard. Disney Plus streaming business has seen a pickup on Q2 when they were expecting a reduction. But I'm struggling a bit here because, okay, it's around about $119, $120. I've seen the quality of the films that they released in the last quarter. And honestly, they're utter rubbish. I was going to say. It
was going to be a different word there, wasn't it?
There's going to be a different word there. Captain America, Brave New World, dross. Snow White, dross. Thunderbolts, dross. I mean, you know, the Snow White was supposed to be the big unveil for Q3, and it bombed. Utterly bombed. And why? Because the lead actress in that decided to go woke.
Well, to be honest with you, mate, I never knew that Snow White was up your street, so to speak.
It's not.
But we learn something new every day.
It's not, mate. But the point is, when you've got these big blockbuster films, right, you want to get bums on seats. You want to get people through the door to see the big screens. And ultimately, all we're getting is remakes and crap.
Yeah. No, I do agree with you. And I think risks are probably tilted to the downside on that one.
So I would be very surprised if their Disney Plus subscriber numbers or their film division does particularly well, because these films take an awful lot of money to make. Fantastic Four is another one, which is likely to have bombed as well. You know, there's
incredibly
nothing
expensive.
original. They're incredibly expensive films, you know, and they need to generate revenue, and they're just not doing it.
No, not at all.
Okay, so anyway, so not confident on Disney. I may be surprised. Maybe the parks division, the cruise division will outperform,
prop things up a bit,
and prop things up a bit. But the streaming division and the film division, really, Bob Iger needs to take a chainsaw to those divisions and really start to increase the quality of the output, because it's utter dross. Anyway,
Uber, lastly, isn't it?
Uber, lastly, yeah. Second quarter numbers, they're actually starting to become profitable, and who would have said that 10 years ago?
Well, exactly. Do you know the other thing that Uber have started doing? They've actually started turning up when you call one in London, which is perhaps even more miraculous than that.
I've never had a problem with Ubers not turning up, whether it be in the US or the UK, so I can't possibly comment.
Maybe that's more to do with my rating, but we won't go into that.
Well, they do rate the riders as well as the drivers, mate. maybe. Oh God, it's that moaning Michael again. All right,
I'm on some sort of blacklist, probably.
Yeah, probably. All right, guys. Well, I think that's it pretty much for this week. We've gone slightly over the hour, but plenty to chew over. We'll talk about Amazon and Apple's numbers next week. We'll talk about the Bank of England. Talk about payrolls as well, as I would imagine.
Yes, of course. That's tomorrow, isn't it?
Which is tomorrow. So on that note, once again, thanks very much for a very informative chat, Michael. It's been fun, and I'll talk to you same time, same place next week.
Always a pleasure, mate. Bye for now.